you're overpaying if you end up investing into a YC company, at least over the last few years. I think it's more of a challenge to actually these days to back a YC company, but some funds made it their pure strategy, right? And they've been fairly successful.
This is Anton. He's an angel investor and partner at Flashpoint VC, where he invests in Series A B2B SaaS startups across Europe and Israel.
The biggest challenge that I've seen of founders really well articulating how big is the TAM, whether that's through vision or in immediate market size that they're going up. In the public markets, it's the returns are also power law. People are talking about the bell curve, and yes, on a daily basis, it's bell curve, right? But if you look at long term, it's the same. At the end of the day, it's the team that builds companies. It's not the founder. Founder is organizer of capital. And I've done so far a little bit more than 15 investments. I have done one where I lost half of my capital. So that's probably the worst. A minute after you wire the money, a VP sales leaves, the product suddenly becomes obsolete, and then the founder wants to invest into something. The sad part is that I flew into the office, sat across the founder, the co-founder, the VP sales, who was telling me about the Rolodex of the clients that he's gonna bring. So literally lied to my face. So,
hey Anton, welcome to the show. Super excited to have you. How are you doing today?
Oh, good. Thanks for having me.
My pleasure to have you here. Every single time I have anybody on the podcast, whoever that person is, I always start with one particular question, and that is, what is your story? Where do you come from? What's the context you have of your life? So let's start there.
Sure. It's been a while. I'm actually a laser physicist by training. So before I got into the VC world, I thought that just like my dad, I'm gonna be studying physics and doing laser experiments. And I did that for a few years while I was in college. By probably senior year, I kind of realized that I don't have what it takes to be a physicist. I'm not that passionate about science to really get laser focused on a specific problem. And it's not 2-3 centuries ago where you could have been very generalist physicist. Today you really have to be laser physics, and I don't know whether that's crystals or ceramics or some other stuff. And so I kind of said, okay, now I'm gonna go into finance, and basically picked up a CFA book, read through it in a course of a week. Basically there was a job fairy at my university, and so KPMG was saying, okay, people who want to get into finance, this is a good path. And so I said, yes, great. I don't know nothing about finance, but I read this book. And so I passed the interview and basically landed a job at KPMG in corporate finance. Did that for a year. You train in Excel as a laser physicist doing this research, etc. So I was pretty efficient in Excel. So I was good at corporate finance as well. So because that's all you do, build models. And so after that, I got poached by a friend of mine who was already trading stocks and bonds. And so I joined him. I was one of the largest desk managers in Central Europe, mostly managing pension money. And so I got exposure into public markets, relatively early in my career. And so you get, to research in a lot of the stocks and bonds, and that's you get macro, basically experience what are interest rates, why are they important, and so what a central bank, what does it do, and so you get basically macroeconomics 101 on the job, and did that for a couple of years, and then we joined the high net worth individual who was basically launching his family office, starting to invest into private companies, basically through that gig. I got exposed into private markets, and then I saw there was flow coming into Europe already in the earlier parts of the previous decade. And so I thought, okay, I know how to code, because most physicists do, because they need to write a script for their experiment. So I built a team, basically drained all my savings into the startup. We built a product, launched in 3 months. It was, got SEO, learned how to, acquire users, got to first early revenue was a few tens of thousands of dollars a month. but the unit economics weren't great. We just decided let's build something, and we built something. And so, but that something, didn't really had a lot of long-term value, I think. And so I had a kid on a way, and so like zero bank account, and I thought, okay, like this is pretty interesting to like do something in technology space, but probably and being entrepreneur, it's a lot of this, kind of like cosine function or sine function, a lot of volatility, and so I wanted a little bit less volatility, to be honest, and so I found two investment bankers who, did IPOs for a living before, and they launched a fund. It was a fund one, Flashpoint Fund One, and basically I said like, let me join you, and so I did, and I've been here for 11 years, basically building Flashpoint together with Alex and Michael.
Awesome. Do you miss being a founder?
I think there is a joy that I miss when you ship out something and when you get that user traction. Somebody buys something, for the first time, or you hit that, and there's daily milestones, but I think it also comes with a downside, because everything, when somebody churns, and especially in the early days, it's very hard to put that emotional distance. You live the company. And I think in the investment world, and running a VC firm, I think there is still volatility, but the volatility, if to describe it sort of using math, as you have running a company is like a function that is, I don't know, sine of 2x, let's say. So very, very volatile, but running a VC is sort of like a sine of x by 2. So you still have this volatility of good periods and bad periods, but you have to really time to adapt. You don't have this daily emotional swings, and so some people, basically live on that, thrust of, joy and disappointment, and that's how they energize. For me, I want a slightly more paced environment, and I think VC is the one where you still get that, and running VC is running a business. It's not that different, but everything is a bit slower versus a company.
So starting a fund, a really difficult thing, because when you and I met for the first time, we talked about what does it feel like to be a GP or a fund manager or something.
I think there is, and it depends when you're just starting out, or when you've already been doing that for a while. I think there is definitely more structure when you're doing it not for the first time. But when you're launching an organization, you're pretty much, in a sense, don't have any processes for the most part, right? So like in a company. So you need to figure out, okay, how's the deal flow is going to go, right? So then you go into, okay, I got the deal flow, so I've got pitch decks and meetings with founders. That's assuming you already raised capital, right? And so if you don't have raised pool of capital, then you need to figure out how you're going to raise it, right? So and so there's a lot of selling involved in the early days. But when you're launching the fund for the first time, I guess the first thing to probably answer is what's your angle? What's your unique selling proposition, both to founders and LPs? It's very hard to launch generic fund, I think, these days. So you need to either go on a specific founder set, whether that's being very geographical focused, or very vertical focus, right? So you might go into deep tech, or you might go into cyber if you have background in cyber. But basically, the next step is trying to unite that ICP with the target LP audience that you're trying to raise money from. So if you have access to institutional money, then your job is a little bit easier, because they typically write bigger checks. So you need only 5-7 names to really kick off the fund. You could have your anchor LP, and then around that anchor LP you might have another 5-7 LPs that are half the size or a tenth of the size, but that will get you enough to get that first closing. If you don't have access to institutional LPs, that's where things are becoming a little bit more tricky, because then it's probably like at best family offices, but or just founders or high net worth individuals, and so they don't really write large checks. So you need a like sheer volume of them, right? So in that sense, you almost have to sort of like, and it's like a marketplace, right? So you need to solve one part of the marketplace, right? And since you need funds to invest, your investor is your client, and so not the founder who's ends up getting the money, but your investor is the client. And so you basically have to start pitching something that you might not have. So like, okay, I've got this pool of capital like already raised, and so then you go and actually raise it, and then you need to do it quickly, right? So you need to pre-wire a lot of the early discussions in terms of that. You might be thinking about it, like, and then pop up, oh, here, I've got this fund, that's how you raise it. So you get to the first milestone, then you go and try to raise the next milestone while at the same time doing deals. So raising a fund versus raising a round, I think raising a fund is much harder, because in a round you only need like one lead investor, and then typically everything, like everybody's kind of gets brought in, and in a fund structure, you really need to get that pool of 10, 20 people, which is a bit harder, because like that's why people go to YCs, for example, right? So because there is no lead investor per se, and so when you go into demo day and you get like 50 demo requests, and then you get that motion started, and so that's how you get raised, basically syndicate rounds. A lot of companies end up doing that. That's what's valuable about VC, like YC, for instance, is that you get that fundraising ultimately solved, and so you might basically give them 7% stake to organize that process, just like you would, give an investment banker, right? Like 4 or 5% of the total raise. So giving it to a banker probably is going to be cheaper, but you also get the YC logo, which customers love, and it gives like a stamp of approval, especially in the US corporate world, that this is like somebody is great.
So question around YC, because I do have the idea from the founder's perspective. There's tons of people that I know. They've been applied for YC. Some of them got accepted. Some of them successfully graduated from them, and they went on to the subsequent round. Kudos to them. But from an investor perspective, what value does YC provide, or Techstars would provide to the VC world?
Well, usually it's you're overpaying if you end up investing into a YC company, at least over the last few years. And it's been different in the early days. So we have a few companies like Guesty who were raised from YC in the earlier days, but that was a cohort 2013.
Oh wow! Okay.
When it's very early on. So when you didn't have 300 companies, basically getting that stamp of approval. So in the early days, it meant a lot, really a lot. So it's okay, you went through that rigorous process. You're among sort of considered among the companies that are in the likes of Dropbox and Stripe and Airbnb, etc. So nowadays you basically get 300 companies every 6 months. I think there is a lot of entitlement, that about YC founders have. A lot of the times it doesn't get back, going forward. And so I think it's more of a challenge to actually these days to back a YC company. But some funds made it their pure strategy, right? Is that and they've been fairly successful, with multiple cash and cash. So not to diminish YC's importance in this world, and they're still pretty good stamp of approval when it comes to spotting great companies.
You're in that ecosystem for quite a while now. So a very nuanced sort of a question. Do you think the startup ecosystem or the startup world needs more YCs? Can there be another YC as well on top of that?
I mean, there's a few funds, accelerators, right, that exist. There's one like SeedCamp in Europe that has done pretty good job spotting early stage companies across your landscape. I mean, there's 500 startups. There is Techstars, right? So there's already quite a handful accelerators that basically have this offer. I'll give you like a couple 100,000 for a few percentage points, usually like pre-revenue, maybe even pre-product. So I don't think actually like you need more of those. I think, today access to early stage capital is pretty abundant, I'd actually say. There's a lot of spillover effect of like CEOs cashing out and giving back to the communities. I think we've seen it, multiple times across, Baltic ecosystem, across Israel ecosystem, across London ecosystem. So founders, build a great business, and then they cash out and they invest back into the founders. So there's I don't think there is like a need for more institutional like accelerator, to be honest.
Okay. All right, cool. One of the things that I do is like whenever I have any VC on the podcast, so I try to understand like what do you guys think when you invest in any company, and that's actually the thesis behind that is so we can help more founders understand like when they're approaching any VC, Flashpoint or any other, what they exactly need to fix, how they should approach the pitch, and all of that, like the entire fundraising process. So that's the entire goal that I do. A couple of things that comes to my mind if we start down there. You have seen like thousands of pitch decks across these years, every year probably. If you could just jot it down, if you could just narrow it down to the three main challenges, three main problems that you see in founders, even to this day, that they're still making the same problem when they're pitching to an investor, to a seed investor, to a Series A investor, what would those be? I mean, there could be like a gazillion. I know you would know the insights, but if you could just bring the absolute pain points, what would those be?
I mean, and like some founders have done it like better than others, but I think the most mistakes that I've seen is an ability to articulate like how large is the thumb. Because as a VC, you're not a private equity, so your whole model is really based on a company able to hit like hopefully triple digits in revenue, right? So because then it's like power law, right? Like, in the public markets, it's like the returns are also power law. People are talking about like the bell curve, and yes, on a daily basis, it's bell curve, right? But if you look at long term, it's the same. It's power law. So and the market cap tends to highly correlate with the revenues and ability to capture market share. So just like in public markets, you need growing companies. That's the ones that are growing. So I think that's the biggest challenge that I've seen of founders really well articulating like how big is the TAM, whether that's through vision or in immediate market size that they're going after. Because all of the big companies that have really made it into like the decacorn, there's like a term that got invented, like tens of billions of dollars, right? Have been, either like construction, like Procore, right, or like in food delivery with like I don't know, GoBot is like one example, like or DoorDash, right, or like travel with Airbnb. It's like huge thumbs. There's like 600 billion thumb, right? So or like with Uber, with like transportation and like started as a taxi, but even taxi market is like it's tens of billions of dollars. So I think this is like the biggest one. I think people don't talk enough about their ability to hire. They are generally talking about like great team, but I think people need to spend, in my opinion, like your ability to hire and like not just who you have today, but who are the next 5 hires for you. And like if you can articulate that it's only capital that is a constraint to get that amazing team in place, because it's at the end of the day, it's the team that builds companies. It's not the founder. Founder is like organizer of capital and recruitment, basically. And I think the last one is probably like what we've started to notice more is founder market fit. I think as the environment has gotten like substantially more saturated with just the sheer of companies. Also, like a decade ago, like the the VC world hasn't been, $300 billion invested every year. It was probably like 1/10 of that. So in that sense, you get a like substantially more competition. So you really need to have that unique insight. And typically, like if you are founder not from this market, it's much harder to really like be the one to further expand the market size and further to like iterate on the problem and expand the product. Not that it's like impossible, but I think this is just makes your job a whole lot easier not to like reinvent what has, or re-educate yourself about the industry. I mean, like I keep on going, like but those are probably the three.
One thing that caught my eye, I think somebody was like reading this thing very recently, and that was around fund cycle. So fund cycle, from what I understood, is like, which stage of the life of the fund that you are in. So for example, if you raise whatever, the life of the fund is 4 years, you're already into 2 years or 3 years. So you're almost at the end of the fund cycle. So what exactly is a fund cycle, and why founders should care about that? Like how does that impact founders, and why they should care about that? Because most people would think about, like most founders, some context to you, like most founders that I would meet, they would just approach all VCs. Suppose you invest in Series A, so they would approach all Series A in that vertical and think about exactly the same thing, without even knowing the fund cycles, without even knowing the check size they can write, the fund size that they have, like all of these things. So how important is all these nuanced things for the founders?
I mean, it is quite important. I think this is what separates, a first-time founder from a second-time founder typically, is like actually knowing and like what to ask a VC on that first call, because it's not that like obviously the founder wants to raise money, so he gets to talk the most. But I think it's that opportunity basically for the founder to get get the feedback about like the VC that he wants to partner with, right? So and so it matters for a few reasons. One is that sometimes people announce things, right, but like they might have done only like the first closing. So in reality, like their ability to, for instance, follow on might be substantially less, right? So if you don't have like a big enough fund for follow-ons, you might not end up following. Not everybody follows on, right? So I think it's also important to get it up front, because sometimes like founders think that everybody follows on. Well, that's not really the case. There is like benchmark. It's like they're like typically well known for not following on it, right? So they like write check once and that's it. So in that sense, like it's you really have to know like who are you getting in sort of in bed with, because it's like a marriage. So you might want to ask all the right questions beforehand.
Yeah. So sorry to interrupt. Like, what question do you think founders should ask a VC when they get on a call? And this is the question that pertaining to a topic which I hold dearly, which is a VC founder fit sort of a thing, like investor founder fit. So how do you figure out exactly the right partner for your marriage? So what question do you think they should also ask? Because most people, they're like, yeah, like no questions, just give us a check, that kind of a thing.
Well, I think it's important. Like not everything goes according to plan, right? So I think it's important to get that answer to like, are you following on, and how often do you follow on, right? And so some funds, they basically have like automatic follow-on strategy. So they might like write a small check and their follow-on isn't as large, but they kind of give it up front that like, okay, I'm writing a small check, but like I already baked in that I'm going to do a follow-on when there is a next round, right? So that's like number one. Number two is, when you are following on, like what's that mentality in mind, right? Is that like a separate investment decision? How deep do you want to do like due diligence upon like next time you want to like write the check? Because sometimes also founders assume that like whenever, like if you're on the cap table, it's like there's no due diligence, right? And people don't want to know like what's especially if they're less active and involved, so they might think that you're just gonna like, okay, here's an update, just like wire us the money, right? Like Well, with some funds it is like that. With people who are more hands-on, it's less of a case, right? I think the best way for founder also to test VC, to be honest, is like after the call is try to ask, VC, like who would be like a great founder reference, right? Like who would, and because that also would give you like a good feedback loop. Would that VC like connect you immediately and like, provide that instant introduction? Or he might name a few names, so you go out and like do it yourself. Because if like VC wants to offer that, right, like often that probably means that he's like more excited. He actually wants to use his network to I don't know, impress the founder. Or if the VC is less, involved in that process, and it's up to the founder to like realize that maybe to me like VC is like maybe interested but not like substantially, and not as excited, right? So he might actually end up doing a deal. It might just take like not like 2 months, but like 6 months. I don't know. Like so there's different dynamics that you can actually exploit. You just need to think in advance about what to ask. But there is definitely a way to test VC's interest, because nobody like, well, not nobody, but like a lot of the VCs don't really say no, because they don't want to. Because if you said no, it's much harder to say yeah, no, I changed my mind, and like get through FOMO and basically like actually like commit. But so it's the art of saying no, like
saying no.
but exactly. So in that case, I think you can actually exploit the dynamic for your benefit, to get a reference on the firm that you want to partner with, or just check how serious is a VC, right? Like, should you are they going to the next step? Do you want to give them like more data and for them to get more educated?
Got it. Okay. A couple of things around Flashpoint, especially. So we were doing some research, our own due diligence on Flashpoint in a funny way. Then we just come across like there's a few venture part that you guys offer. So there's a fund, then there's a growth debt or something like that. So 2 questions on top of that. Like, so first one is, why all these products exist? Like, why is that helpful? And why anybody should consider a growth debt? And this is probably a question that I'm going to ask Dennis as well, but just want to take your opinion on top of that as well. Yeah.
I mean, when we were scaling Flashpoint, I think after Fund 2, we started to basically think about like, okay, like, do you just like grow the fund sizes, and that's the way how to grow the business model? And the bad part about like the venture capital business model per se, like the asset class, is that it's a very like chainsaw type of a business model, right? So similar to like a game of musical chairs, I think that's what it's called. So you basically everything is nice and shiny until like the music stops, right? And then there is no funding. So like and the market kind of saw it like 2 years ago. And so if you didn't raise a fund in the right environment, and you just ended up investing at like just before things got bad, and then like generally the portfolio is more likely than not is going to suffer from the market environment, and so you might actually have like a very hard time recouping from that, right? So if you invest into different asset class that has synergies with your core product, then you might basically diversify you a little bit, right? So that's how like the idea of venture debt and growth debt basically emerged, is that it's a debt instrument. And so whenever things are, basically like bad in the market, like they were a couple of years, like over the last couple of years, like I think the market sort of started to pick up like earlier this year, and maybe towards the end of last year. I mean, there is almost no funding, and only like large funds are mostly supporting their companies because they also have to maintain the books. And so they don't want to write it off until their next fundraising event. And so you might do it through a venture debt instrument, because, if equity is not there, then you need to supplement it somehow, right? And banks typically run away when there is a crisis. I think everybody saw it with during the Silicon Valley bust. And so like no banks are, funding startups or like even growth companies. So that private debt is like really the only option. And so demand for that goes up, right? So and you can get like best quality of companies like during that period. And so, but that's like also the synergies that we invest on the earlier stage side into Series A companies. They have like $1, $2, $3, $4, $5 million of revenue. That side invest into companies that are typically like 5 to 15 in revenue. And so basically, if we miss something or we don't agree on like valuations, right, we actually can try to partner with a company on the next stage. And so that also allows you to basically give like the company an offer that they might be interested in, while not also competing with like Series B funds, right? Because this is like something that goes on top of a Series B like fund or late Series A investment. So you want to be a partner to them and not a competitor. So that's the beauty about like doing like multi-product company, and we haven't seen too many of those. I think there is probably like one in Israel, like Viola, that has done like a multi-product company. They have a debt fund, they have a late growth equity fund, and they also have early stage Viola Ventures, early stage fund, right? So they're a multi-product, but there's not too many examples of that.
Thank you for explaining that. I appreciate it. So when you get like, give us 2 insights here. How many pitch decks do you see a year? And what do you actually look for in the ones that you actually think, oh, these are investable? And what stage usually you invest in?
We basically measure stuff that we were outbounding a lot. So because we are focused on founders from Europe and Israel, and ideally from Central Europe and Israel, we believe in the thesis, and our thesis is those founders typically are more efficient. And so because they're more efficient, they'll need less capital to build that big business. And eventually they might be, having less capital in the earlier days. But, if they grow, they'll become just as a US company and nothing differentiate themselves. And right, they might domicile themselves. And the founders typically also move, closer to the US market once they're big. Because of that, because of our office infrastructure, so we have people all across like Europe. I'm in New York, but most of our offices are in Europe. And so we look for companies that are typically already like, built teams. So what's team is typically like a 25 to 40 people team, right? So before that, if you're investing into B2B software companies, it's much harder to, operate a B2B software business with like 10 employees. You need to have R&D and like marketing and customer success and, sales execs and support. And then you probably have like some HR already in place. Maybe it's outsourced, but so you need the controller, etc. So cash collection. So you need like, a 25 people team if you're investing into companies that are doing like over $1 million of revenue. That's who we focus on. So companies that are typically doing 1 to 5. In terms of, what makes us excited, relative to like whom we talk, is it probably goes in that order. I want to see like a huge TAM. And so if you don't have like a $10 billion TAM,
Dump? Like, what do you mean by dump? Like the
TAM, like total.
Okay, so TAM. Okay, yeah. Got it. Total TAM. Okay.
And so, yes, your like serviceable market might be, smaller, but like you need to understand how that big like TAM like gets exploited, right? Because otherwise, like there is no way how a company can get with like $300 million TAM, like $100 million of revenue. That's like impossible, right? So there's very rarely like that much monopoly. Like maybe in certain markets there is, but like in most markets there's not. And so that's the first one, right? Like I want to understand on that first call to get a feel of what is there like an experiment driven culture inside the company. Because from my observation, and maybe that's where laser physicist shines through,
Okay.
or a wannabe physicist, is that like running like if like a venture firm is like running like multiple experiments, and running a business is like running like a lab basically. And so you do a bunch of them, and then if you like they're good, that you like put more resources there. And so I want to understand, does that like founder has that experiment driven culture? Because also to do an experiment properly, you have to measure stuff. And so that also answers like how good will they be on the reporting side. So if they don't have this experiment culture, probably is going to be like bad stuff on the reporting side. And so like as I said before, right, like ability to hire is like super important, right? So do you see like at Series A stage, like how many of those mid-level or C roles has that person? There's probably less C roles because only like the founder is like called chief executive officer. Probably he's not the like CEO yet. He's like still a founder. But ability to grow into that C role of the founders, coupled with ability to hire like quality mid-level folks, because a lot of founders like also will give like titles away. That's like bad. So if you like if you have like a CFO at the stage of $1 million of revenue, like you don't understand like
I know.
what a CFO does. So I mean, if you're a founder, sure, you can name whatever you want to name yourself, but it probably means that you don't really know what that person should be doing. And so that tells you also a lot, like, is that person really hired like a head of finance, who is then VP finance, who is then SVP finance? And then maybe like once that person, will try to, get the company public, then that'll become a CFO, right? So, and that, understanding, like how to give care, to the team that you're hire also, because it also tells me about like, are you able to grow into a professional CEO role, or you're just a founder yet? So, and then you need to like, and then together with the shareholders, like, and the board, you need to be working with the team on that. Yeah, I think lately, like, you also want to understand, given that we lived through like two different, let's call them boom and bust cycles of COVID and then interest rates. I kind of want to understand like how resilient that person. So because sometimes you really need to have a lot of resiliency. Not just like that you're passionate about a problem, but how much trust can that person withhold. And like I think this is proven to be also like an important trait.
Okay, so two questions on top of that. So one is, what differentiates a founder from a CEO or a C-level exec? And two is your thoughts on hiring fractional executives, fractional CFOs, CMOs, CPOs, or whatever.
I think the difference between a founder and a CEO is lack of systems. So like if you're still a founder, like you probably have less systems. Like I think once you have systems in place and process design, then things will start to fall into, then like everybody understands what that person like role is and like what needs to be done, and then there's metrics. And so ability of founders to build systems and hire people to run those systems and build new systems is basically what defines like a CEO relative to a founder. Like founder typically is the one like who is fixing shit, and then the CEO is usually the one who's got like a person to fix that, right? So and process and how to do it. I mean, I think people should hire like great people, right? So it's very hard to like grow if you're not like a professional into something that you're not, right? So And it's fine too. Like, and you should be hiring the best people that exist for that particular job profile, right? So if you if you run like a B2B software company that really relies substantially on on marketing, and then you landed like a great VP marketing, hire him, right? Like he'll educate you what to do, right? So I think it's important not to rely, before you understand on what needs to be done yourself, because people who haven't lived through understanding what the problem needs to be, like how it needs to be addressed, usually end up actually like hiring and firing because they thought that okay, he's gonna like do everything, and that usually is rarely the case. You still need context, and like it's usually the founder and the CEO who gives that context to make sure that the things gets fixed or built. But as we're typically a lead investor, we try to help on hiring the mid senior execs, and there is great also people like agencies who have a deep network of great execs, and we try to match them to, and but we're always like present on the last like, stage of interview. I think it gives perspective to the founders. What as a non-operating executive like thinks about that person. It's very easy to get excited about a candidate, and especially in the US, people are really good at selling themselves. So as an investor, you kind of typically cut through the bullshit much quicker without like alienating like that person, because you're not like, I'm not day to day, right? Like I'm day to day with the founder maybe, or like not even day to day, but like week to week or month to month. But so I can be like more blunt and more direct with that candidate.
Awesome. Thank you so much for sharing all the things, Anton. So what we do is we have a decent big of an audience, listen to the podcast, read the newsletter, and now also a private community of venture-backed founders. So what we do is before anybody's coming on the podcast, just float out this questionnaire like, hey, Anton from Flashpoint is coming tomorrow. Any question you would like to ask him? So people submit all kind of questions, good ones, bad ones, like all kind of those, like you could imagine. So we've just managed to screen them down to just 5 of those, like 5 really good ones. So I just want to ask them in no particular order. Okay. So the first one is your thoughts on founder who have raised down rounds and have taken liquidation preferences recently. What do you think about those?
We are not a great believer in down rounds, to be honest. I think the best way to do a down round is do a flat round.
What's a flat round?
Well, in a sense, you can like do a down round, or you can try to structure, when there is like additional warrants and other mechanism, right? And so I think it's also your ability to negotiate a deal that is interesting for you, that is important. And so if you are the founder who basically accepted a down round, things must be pretty shitty. So, if things are pretty shitty, like, why would you want to like invest into the future, right? So I think things probably should be doing at least flat for you to get like, okay, now like you've gone through the flat, like get excited about the future. Here's the product, here's growth. I think recovering from a down round is like quite hard. It's not impossible, but it is quite hard. Like liquidation preference, they always exist. Like, so I think in the earlier phases, I think in like Shazam case that we're back in the early days, it's got like different stacks of participation preference. So I think it's the size of the liquidation preference that really matters, right? How under the stack are you? If you are raising like a Series A round and there is $20 million of liquidation preference ahead of you, and like revenue is like 1 or 2 million, then you've got a lot of questions. Like it's really like you must restructure your cap table. Like, no, well, in my opinion, like no serious enough investor would like spend time before you actually restructure stuff. So not, but I mean, it's sometimes it's quite hard. I mean, that means almost like shutting down the company because investors don't want to like lose their, you know, their preference rights. But I mean, shit happens. So.
Yeah. Okay. So the next one is, so this is actually a founder, and he is telling like whatever the story that they have. So we feel like we have a great company. We have lost more than 50% of our 50% of the cap table of the equity before our Series A. What options do we have, and would you be interested in backing such company with huge potential but a messed up cap table?
Well, I think the question is how messed up it is. Like
Yeah, they lost like
but
more
if
than
you,
50 before Series A. So I think
well,
they're about
like
to raise a
more
Series
than
A.
50 is like, 90 is like more than 50 and 55 is more than 50. Like those are two different numbers, right? So let me give you like, because if you raise the pre-seed round and they gave out like, I don't know, 20%, and then you raise the seed round and you gave out 20%. So then you raise the seed extension round, like another one, right? Raised another, lost another 15% dilution. You're already like at 50, right? So it's like it's almost like an everyday scenario in this market. Like, I mean, I don't think you're alone in that case. However, I mean, we've backed company that had like founders owing 25%, and they were jumping out of COVID with great traction. Hit like $8 million in the year that we invested. In the previous year, they had like 1.5, right? So they have like great growth, right? So we backed that despite the founder team having like 25%, we still back that company. I think that the challenge that arises for the investor is really understanding how long-term thinking are you? Because if you're like diluted to 25%, a lot of investors might indeed think that you're not committed for the long run, because you might need still to get another 3, 4, 5 rounds of growth if you really want to get that like strong return. So I think also a good way to do that is to create ahead of like when you approach investors and that question gets asked, is to think about it strategically ahead of the call and ahead of that fundraising round, and like align with your investors that, for instance, you're not going to get diluted through that round, and the existing investors are happy to get you, non-diluted through that round. But you probably need to align that on that topic with your shareholders before you actually like do the fundraising. It's harder to like do that in the same time as you're doing the round. So that would be probably my advice. But if the company's great and you structure the compensation and the long-term motivation right, like nothing should preclude you from like raising like a round.
Okay. All right. So the next one is, of all the series, like from pre-seed to series D or like whatever, what's the least risky series round or series looks like to you? It's a weird question to ask, but yeah, anyhow.
Well, I mean, everything has a risk return.
Yeah.
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 So I mean, if you don't want to make money, you can just like invest into pre-IPO companies, right? So I think this is
Yeah,
like
that's the best advice.
probably like so. I think what historically has been the case is that most repricings for shareholders have been either from seed to Series A or from Series A to Series B. I mean, we only do Series A, like 90% of what we do is Series A. So we feel like the risk reward basis is great at Series A, because usually you're not gonna lose the company because of like bad churn, and so you already have that product market fit going or about to have it going. I mean, maybe it's not like 5x growth, but 100% growth, like 70-80% growth if you're like 5, 6, 7 million already of revenue. Also Series A is different in like different countries, the definition of it. But generally speaking, I think Series A has the best risk return in terms of what you can hope in terms of like next repricing. Because after you like at Series B, the repricing from B to C rounds is typically less than 2x in absolute terms, and then the rounds are bigger. So that means also that like on a price per share basis, you might only grow 50%. So, but that's like not a lot. So,
But less risk as well. Less risky.
less risk, but I think like if you ask me like what do you want to like, if you want to have a chance of making like a sort of a 4x return or 4x return, and have some companies that are going to just return you probably cost versus having like more chances of kind of doing like a 1.5 to 2x, I'll probably pick like, okay, no, like I'll have like those that are, that can triple, quadruple into the next round and really shine through. Because like a Series B that is growing is going to be so overpriced.
Yeah. Yeah. Agreed. But that plays lovely into your hand. I mean, that helps you if the Series B is overpriced. No?
I mean, if you're investing in Series A and then everything's great, then that's why I'm saying like you want to have those chances where the company is going to make like from A to B, like 4x, right? So you don't see it too often, but you do see it.
Okay, awesome. All right, so the next one is, what's the process of making an investment decision at Flashpoint? Like, how do you do all the due diligence, like whatever, and what do you look for when the team does the due diligence?
Well, we're striving ourselves as like a data-driven VC. So we'll ask for like substantial data, like after the initial call, like if we really want to get dive in, right? So, but the process looks pretty straightforward. You meet with a team. If we are like very knowledgeable about the topic, we'll try to arrange the call with a partner as soon as possible. Maybe in the first meeting we'll be with a partner. It's hard to like do all of the calls because we do have like 1,500 calls, so and like only 3 partners. So it's a bit tougher to be on like all of them at the first time.
Why not hire another partner? Just a random question.
Well, I mean, economics then of the fund makes it like less appealing. So so there is a mix towards like how much capital you manage versus how many, what does your pyramid looks like. And so after the meeting, like we typically ask a data request that starts from either granting us access to your analytical system, like some people use whether that's ChartMogul or other systems. We also built our own like cohort maker. So if you just send us the raw data, just like CSV file, and some people are just like, here's a CSV file, like weighs like 5 megabytes, just upload it into a Python script that we wrote to basically like decompose like everything. So with in 2 minutes you basically get the entire, like if you don't need to clean the data set. So you get very clear picture of, what's the, net new ARR per month with the churn, how's it split by tiers, so you can do like analysis relatively quickly. What we try to like, if we like it, we try to basically ask for a few customer calls. And then after we have those a few customer calls, we do a partner meeting, and then, hopefully we'll give you a term sheet. So the process can be very smooth if access to data is there and if access to clients is there. So, and if the interest is there, right? Exactly. So it could be like we've done deals in like 3 weeks. Like, I mean, we haven't like done deals like where like wiring the money like, next day. We've been like diligent focused, but if things are, great, and like, sometimes we ask to verify, like, I mean, especially when there is less data points, like if you're looking at like enterprise software company, And so you might not have too many data points like to really do like a court analysis, et cetera, so to like verify, but so there we might ask, to really understand your cash cycle. So to understand like how much like money has really hit the bank, and what has been the cash choppiness, because you might have like 10 customers, and so that's the fastest way also to do due diligence, right? So and it also tests like how founders are how transparent are they willing to be, because it's not like we're going to find like we might only find if like somebody's lying to us, right? So like there's nothing else to find, to be honest. Like I don't really care how much the founder is he paying himself, like $8,000 a month, $10,000, $12,000 a month. I don't know. Like if you've got the budget to pay yourself a good salary, like pay it. Like who's against?
A separate question. It was a question actually on the list. I'm not going to be part of the recording. It's going to be. It was a question on the list. How do you decide your own salary?
For what? Like across the organization?
Like how much Anton decide, like how much he should take, or like who does decide that?
Well, we like as a company, basically we have the group itself like raise some capital out, like who invested the GP basically, and so we have a compensation like committee, and we signed a policy, and like this is what it looks like. There's grades and everything. So pay gaps, like standard stuff. So I think you want to run a profitable business, right? So I think you need to reach that scale when you run a profitable business. But when you manage $500 million, you can run like at least a break-even business. So then the question is like, do you want to turn profit, or do you want to invest into like people? So then it becomes like more of a strategic discussion with the board at the group level.
Okay, awesome. Rolling again. All right, so thank you so much, Anton, for answering all the questions. So we do have this one small ritual on the podcast. So what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. Okay, so I got a question for you. Also going to take a question from you at the end. So the question that the previous guest left for you is, what are the 2 best and worst investments you have made in your investment career, in your VC career so far?
Best. I mean, it's like the question is, how do you define best, right? Is very subjective. You can base it on IRR, right? So if you made double your money in like 6 months, you've done a great IRR, right? So so this is great investment, right? I have got one of those, right? So we have a company that invested like $15.5 million, less than a year, basically turned into like 40, right? So great investment, right? So this is great. It's like in public markets, hedge fund. But because I've allocated, decent chunk of the capital to that investment, I was like hoping to do like a 7x, 8 times on that money, right? So like, is that great or not, right? So it's like this missed opportunity, like, and a lot of the VC funds are valued on like cash on cash multiple, right? So even if you double your money like in a short period of time, you're going to have a great IRR, but like cash on cash multiple isn't going to be great, right? So you're going to have DPI. So I'm like saying like that I've done a great deal because it produces DPI. Everybody loves DPI in this environment. I think that I've done so far personally like a little bit more than like 15 investments. I think I have done one where I lost half of my capital. So that's probably like the worst, is where you've basically wanted to you hope for the best, but then like a minute after you like wire the money, like a VP sales leaves, the product suddenly becomes, obsolete, and then like the founder wants to, invest into like some.
What the, like, how does that happen? How does that happen? Tell us more about that.
the the sad part is that I flew into their office, like sat across, the founder, the co-founder, the VP sales, who was telling me about the Rolodex of like the clients that he's gonna bring. So like literally lied to my face. so so I'm like cheering myself that I like like engineered a situation where at least could like recoup like half the cost. So like this is probably the worst deal that I've done. Like also like until you sell something, right? So we've got like great companies like that we've backed, and we're still on the cap table and they're growing. But until you sold it, like you hope for the best outcome, right? So we have a company that returns the fund. So this is great, like and like once we sell it, then it'll be a great investment. So
Okay.
So it's a mix.
Okay. Thank you so much, Anton. Lovely talking to you. Thank you for all the wisdom. Thank you for the time, consideration, and candor. Thank you. Thank you again.
My pleasure. It was great, Chen.
This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.